Well, g'day there traders and friends, my YouTube community right around the world. You are here with James on behalf of Pivot Point Trading, and what I'd like to do for you in this particular video is break down the first three stocks in this little watch list I've created. As you can see on the left hand side of my screen, I've got Walt Disney, Facebook, Home Depot, Southwest Airlines, Micron Technologies, and also United States Steel Corp. So this is going to be a part one of a little two-part series which I will make public over the weekend. And what I'll do is we'll go through each of these six stocks individually and look for some tradable opportunity over the next maybe 1 to 3 weeks. This is going to be a work in progress where we can at least look at the tradable opportunity. We can go through, in many instances, some of the steps to trade confirmation, but also for me to share with you my opinion of what's going on technically, or I guess behind the price action which we're looking at on the screen, and to at least sort of convey to you, at least articulate myself in the way in which I expect price to move, and then of course how we can bracket some of these trades if they are neutral enough to take advantage of their impending move directionally with price action. So again, this is going to be a little bit of a masterclass in terms of trade analysis applicable to the six stocks on the left hand side of my screen. If you are interested, again, I would encourage you to persist with this video. If you have any questions whatsoever, email me success@pivotpoint-trading.com, and I'd be very happy to answer any questions or concerns which you may have with some of this individual analysis which we'll walk through with you. So what I'll do, I'll begin with Disney and I will finish with Home Depot. In between that, we will look at Facebook, and then that will be the end of this part one little class. Then there'll be a part two with Southwest Airlines, Micron Technologies, and we'll finish with United States Steel. So here we are, we're looking at Disney right now. The best way to sort of present this to you to begin with is to go out, and this is the daily price of Disney. And what we're doing is we're looking at this on just a closing line chart at the moment. And really what we're doing is we're just getting an understanding of what is going on with just the general sort of price action. Now, as you can see, we're sort of oscillating between macro support and also macro resistance. You can see these oscillations, which I'm sort of defining for you with my, with my drawing tool right now, my illustrating tool right now. I just almost knocked my mobile phone off my workstation here. But you can see roughly from about $90 a share all the way up to about 116 or 120 is the type of range which we're working with over the past 1.5 years, if not two, with Disney. Now, what we've done most recently, this is relatively interesting, is that we have oscillated from $90 up to about, that macro resistance up at about 116. And over the past 1.5 months, this is more so looking at the molecular picture, we're moving back down, and recently we have just, or at least on Friday, we've retested the pivot point of what we call a support line over here at 104. Now, why is 104 important? The reason why 104 is important is because if we look back again historically as to where this pivot point is, what we call, a changeable sort of, location on a chart between support and resistance, where price either has one of two directions to make, which would be the breakdown or the bounce off from support, we can identify it as a potential turning point. And that is what we are interested in the world of technical analysis. We want to understand, well, is there an opportunity for price to move? And if so, how far can it move? And is it worth, of course, us allocating our scarce capital to take advantage of potential reward in terms of that price action? Now, as you can see, Disney has for the second time moved back down, most recently in the month of June 2017, down to about 104 on this chart. Let's have a look at some of the candlesticks which have presented themselves over the past week's worth of trading. We were left with a spinning top on Monday. We have a bearish continuation candlestick on Tuesday. However, on Wednesday, we were left with almost what we would call a hammer at support, which is a relatively early bullish sort of reversal signal. We had an inside day type of candlestick on Thursday, followed by another type of hammer at support. So we're starting to see the candlesticks, or at least Wednesday through Friday, start to suggest that there is buying pressure showing up at about 104 on this particular chart. You can see these lower wicks which have established also. I'm just trying to highlight them for you now, Wednesday and Friday. These long lower wicks are indicating intraday buying pressure right around this pivot just shy of 104, which is relatively interesting. Now, again on Friday, we have the monthly option expiration, which is added to the picture. This is giving us at this particular time a little bit of a false reading. However, even if this is to be somewhat true, we are starting to see volume support. The general assessment that, would support the bounce off from support. We are below the exponential moving averages. They are trending. However, these are the long-term simple moving averages. And as you can see, we've bounced off the 200 once, and this is now the second retest of that 200 simple moving average. If we continue with the discussion, you can also see, especially the MACD over here, that we are relatively oversold and momentum is trying to shift up. So this is relatively bullish in conjunction with that rising long day simple moving average. We've had an RSI which is still relatively oversold, or it has been relatively oversold for a number of months now. And the stochastics, although it is trying to turn down, mixed with these early reversal signals in terms of candlestick patterns, it is, or at least it is suggesting that we may start to see the bounce to the upside. Now the problem is that yes, although we can clearly define that we are relatively oversold, the exponential moving averages, however, are trying to tell us that, hey, we might be in some form of a bearish trend. The reason for that is because we've got the cross happening. We've got the 10 below the 20 and the 20 below the 50. And when you see price action move from an oversold vicinity, generally what happens is we'll push away from that declining 10 exponential moving average, but ultimately we will get the trampoline bounce, or what we would call a dead cat bounce, back up into the declining exponential moving average, which will then act as resistance. Now, not to complicate this any further, but what we're doing right now is we're starting to print a little bit of short-term divergence. We have, recognized the simple fact that we are at support. We may be sort of in a short-term bearish trend. However, that might have run its course. The 116 pullback down to 104 may have run its course, and we may be beginning to set up another oscillation back up to 116, or at a very minimum, all the way back up to 108. So in many instances right now, we're starting to graph the chart itself. You can see the ADX is also elevated. This is telling us that it likes the bearish direction of the most recent price action. And the CCI is still relatively weak. So in terms of an immediate trade setup, we have to be a little bit delicate in terms of our sort of entry placement. I can very easily make the argument that we might see a little bounce back up to 108, and this is a very realistic sort of trade opportunity up to about 108.21. That would be my first target, and that is also going to align very well with the declining 50 exponential moving average, as you can see in my chart right here. But also, if we can break above this little swing high over here, there is also the probability and the possibility that we might run up as high as about 115.48. Pardon me, I'm sort of losing my voice as I go through this part one recording. So, I mean, this is a very interesting type of trade setup. If you're looking at this from a risk and reward sort of standpoint right now, you've got about $10 of potential reward all the way back up to the swing high up here. If we start to see these oscillators switch to the upside, or at least to see momentum shift, at a minimum, your stop needs to go below Friday's low, which is going to print in at about, I can do the maths for you right now very easily. And you can see that we're looking at about $2 and say 50 cents of risk to potentially capitalize on a $10 reward up until that ultimate resistance up here. So you're looking at a reward risk profile of 4-to-1 on this trade based on a reversal taking place on Disney at this macro support area. Now, just as easily, as I can break down, or at least articulate the bullish argument for you, it's also very, or at least relatively straightforward to sort of articulate the bearish breakdown as well. The problem I have with this right now is that when you see price action move from say 116 down to about 104, in terms of a percentage move, this is a pretty decent move. We're looking at least about a 10% move in terms of price action, and to see this stock come down to macro support very closely on 3 occasions now, and to see those oscillators relatively oversold, initially right now I'm hesitating on actually looking at trading this bearish, because oftentimes, and again looking at this one particular candlestick on Friday, you get this lower wick, or you get a suggestion of early reversal signals, and price action might actually flinch a little bit lower. But generally what happens is that it will reverse very quickly, and you will see again the buyers jump back into this stock, and you see price go parabolic to the upside. However, if you did want to be sort of what we say bi-directional, very neutral in your trade approach, I would allow additional room, and I would keep it down here at about 101.73. If I zoom out onto, I guess, the bigger picture again and show you where some of this, where these levels of support are that you need to pay attention to, the one that I'm identifying at the moment is coming in at about $98, but also secondary level down here at 96. So you can see how we're sort of framing the trade in its sort of infancy right now. It doesn't mean that it has to trigger, say, on Monday or Tuesday, but it is what we call a trade opportunity. And whether or not it satisfies your own personal risk and reward criteria, that's an autonomous decision for yourself, and whether or not that this actually agrees with your own analysis as well. But I'm just performing, again, some of this trade analysis, which we do in that pro analysis class relative to Disney, which is outside of our top 12 individual trade list. If we take one look at the Bollinger Bands, this is quite interesting. We're in the lower Bollinger Band, which is relatively bearish, so to speak. However, these lower wicks, which are pricing off from that declining lower band, is indicating potential strength coming back into this stock. So if you start to see candlesticks at least at a minimum move sideways, if not reverse, and move to the upside, and you see this lower band continue and then start to flatten out, that is another warning signal that at least this short-term trend is changing and that we are going to see that next natural bounce to the upside. So that's a little breakdown of Disney. Let's move into Facebook. Facebook is a little bit different. So, if we're trying to sort of look at sort of interesting parallels between these two stocks, there aren't really all that much in terms of similarities. The reason why is because Disney has pulled back quite a distance, whereas Facebook is still relatively elevated. We're back up very close to that resistance. Now, again, if I go out into the daily time frame and show you this on the closing line chart over here, you can see for yourself that we're still in an uptrend. So when I did this on the daily time frame of Disney just before, we were oscillating more or less sideways. So it would look something like this between that macro resistance up here at about 116 or 118, and then that support level which we were at about 104 on Disney. You can see for yourself on Facebook that this has been a relatively straightforward grind, a very slow grind higher to the upside. And what's interesting right now is that we are pushing back up into resistance, and really what we're doing is that we're just retesting this pivot. These trades are fantastic in terms of bi-directional trade opportunities. The reason for this is because, look, we've got a little channel going on, and this channel can continue indefinitely. So if we start to see bearish reversal candlesticks set up at about 154, all the way to 155, 156, maybe we come on up to about 157. But if you start seeing upper wicks, so a little bit different to what we're seeing on Disney right now, it does suggest that we are going to see some form of a rollover for Facebook. Having said that, what you want to be paying attention to when you see a stock coming back up and retesting resistance, especially during a sideways channel, which has more or less been going on for 2 months now, you want to pay attention to what the CCI is doing and also the ADX. If you see price action break above or definitively close and continue above these two swing highs, and you can see my resistance level on my chart here at 155.20. If you see this ADX turn up and the CCI continue to hold above 100 and price action in terms of candlesticks healthy, well then this is a very good opportunity for the trend to continue. And if you look back during these little oscillations, which is sort of began since May 2017, we are still yet to close below the rising 50 exponential moving average. So this is all looking quite okay. Volume is still relatively, average. So, we can't really take a whole lot away from that. We do have divergence. So, you see this little high here and then a higher swing high. And now we've sort of got almost a third relative higher high. You can see the divergence in the face of the MACD, also a little bit there in RSI. This is a little bit problematic. However, as we've sort of identified this on the broader indices in the past, it hasn't been enough to actually reverse any of the markets or stocks at this particular time. So if we do see a breakout in Facebook, again, you have to allow a little bit of fluff, because the last thing you want to do is sort of, jump in at the top of what we call some form of a whipsaw up and around resistance. Is I feel relatively comfortable leaving this at about 157.32. Again, it doesn't have to trigger, but we're just allowing that sort of insurance policy to jump on board, whether or not you want to buy the stock or actually move into derivative contracts, which are options, in other words, traded behind or on the underlying stock price. That's all relatively interesting. I've made the argument for the breakout and the reason for it. If we do see the breakout, you can also get the retest of the pivot. So we've been struggling to overcome this 155 area, this 155.20. If we do overcome it, it is very common to see a stock do a pullback to retest this old resistance, this new support, and then to use that as the trampoline to propel itself higher. So please be conscious and aware of that. Also, if this stock decides to roll over and really set up that channel, there is an opportunity to actually trade this below 150.38. The reason my trigger is at 150.38 is because it's below this open gap here. Now, oftentimes when we do set up a gap on a actual indice, a market, a ETF, whatever, or an individual stock, generally you'll close that gap. You don't have to, but often more times than not, you will close that open gap. So please pay attention to this as well. If you wanted a less risky trade, it would be the bullish continuation. The reason for this is because the exponential moving averages are still suggesting the trend is in effect. And if you wanted to trade counter trend, this is very aggressive, because in the past, if you look back, whenever prices hit the 50 or come very close to it, if not, if it has only touched the 20, you generally see a bounce and a continuation to the upside. So I don't like the actual bearish trigger that I have on my screen. So that's why I'm making this a dotted line. And yes, it does fit the profile or the narrative of potentially that sideways channel consolidation. But when I see these types of trade setups professionally and personally, what I'll do is I'll just keep one of the trades open. And in this instance, it will be the bullish breakout above 157.32. All right. So I just wanted to make that very clear as well. Let's move into HD. This is going to be the final stock of our list. What I haven't done for you is I haven't actually explained the reasoning for these lines, but again, it is relatively straightforward. This is support and resistance, a very basic concept, but also a very important concept in the world of technical analysis. What we're doing when we sort of, in many instances, draw these lines is that we're just really graphing the chart and we're trying to get an understanding of where these pivot points are. If we can understand where the pivot points are or where the turning points are, it's going to help us obviously identify tradable opportunity at some later point. Now that's what we've been doing with those previous two stocks. What I'm doing for you right now is trying to find a trend line which is still in effect. And obviously at the moment it doesn't really look as if we have a trend line which is still in effect. If anything, it looks as though it has broken. So I mean, HD right through to Thursday, or at least Thursday through Friday, it looks as though we have broken this elevated trend line. Now if I zoom out again just to see what exactly is going on, just to get a little bit more price action, we have broken above. Let me just change this to a closing line as well. We have broken above this swing high over here, which has been, you know, also a very, relatively speaking, an interesting level of resistance above 137. We have continued back up into these varying areas of resistance, but what has happened most recently, and this is where the story gets, you know, relatively interesting, so to speak, is that we got this gap up. This is going back to May 15th, May 16th, and then also continuing into the 17th. This is what we call an evening star reversal pattern, okay? We get a gap to the upside, bearish candlestick, and then we get a gap in the opposite direction. This is what creates the star pattern, all right? So this is a 3-day reversal pattern. What's interesting is that we moved sideways. We bounced off from that trend line, back up into that relative resistance area at about 159. However, you can see over the past 4 trading sessions how HD has completely nosedived. Now, this is relatively interesting because if we continue with the analysis, we've just broken below the 50 exponential moving average. Now, a lot of people would recognize this and they'd be saying, look, the oscillators are moving bearish. We've got the cross and the Stokes, the RSI is tanking. We've got, you know, divergence, so to speak, on the MACD. You can see this weakness in terms of momentum, which has just recently crossed bearish. However, what you need to understand is that we do have support coming in over here, which has acted in the past as resistance in the months of March and also and also April. So I mean, we're starting to see again potentially some form of a double top establishing itself on HD. But what will generally happen is that, look, we have some form of a neckline which is more or less presented itself, and it has to a degree broken as at on Friday. Generally what you'll see is you'll see this stock come down to about 159, or it will continue a little bit lower down to about 145. And then you will get the bounce, and the bounce is what matters, okay? So for HD, I want you to write this down if you are still paying attention. The bounce is what matters, because we can very easily sort of forecast what's going to happen or what should happen over the next maybe 1 to 4 days. But again, in terms of the actual trade setup and something that we can more or less rely on in terms of a very nice sort of structural trade is the 1, 2, 3 sort of suggestion. And what I mean by that is the sell-off, the bounce, and then the reversal, which will take place at the neckline. If this is proving to be some form of an intermediate reversal on this particular chart. So what I'm going to do for you is change the color of this box, and this is a red box which sort of symbolizes resistance. Anywhere in this area, and this is also coinciding with this neckline, is where we would expect the sell-off and the bounce to sort of slow down and ultimately turn at a later date, okay, and ultimately do something like this. So this is a trade setup where we can very easily identify where price should be going in the immediate sort of future, or the foreseeable future, which is 149 at a minimum. But it doesn't mean we have to act on it. The reason we're not acting on it is because the risk and reward, say for instance, if we shorted this below Friday's candle, our risk, or at least our stop on the trade, needs to be placed above the higher Friday's candle. And if you look at this in terms of risk, okay, just here, and this is the reward, so to speak, just here, it really doesn't make a lot of sense. It probably is a 1-to-1 at best. And it really, I mean, in terms of potentially the Disney trade being a 4-to-1, you can see how, you know, even when we go through this analysis, or even the Facebook analysis, if this is going to be a legitimate breakout, we can start to do some Fibonacci expansionary levels, which is something which I didn't do. Again, this is a little bit more of a delicate type of subject, just to get some rough types of, you know, targets for us. And again, a really reliable target for Facebook, so to speak, is all the way up here at about $170 or 170.71. Again, we can find confluence areas or areas of Fibonacci confluence, but generally once you get these wave oscillations and project them out in terms of Fibonacci ratios, I'll color coordinate this purple. The reason it's 170.71 and not 171.68 is because we don't want to be greedy and we'd rather exit our trades a little bit early, take the profit, put it in our back pocket, rather than try and sort of shake out every dime out of the actual trade. But going back into HD, back in terms of risk and reward analysis anyways, because look, we can identify a pretty realistic trade opportunity, but just because we can do that, it doesn't mean that we have to allocate capital to the trade. It's always good to understand, I guess, the nature of a stock and where it should be moving, but also to have a game plan around, well, where do you want to sort of begin trading this stock? Where do you want to start allocating capital? Where does it best make sense to actually do this? And this red box, at some later date, most likely in the month of July, is going to be the tradable opportunity, depending on what happens, if this is a legitimate break of the pivot point. And then, of course, the back test, which generally results after the breakdown of the neckline. And this is coming on after the evening star reversal and the relative high, which has since completely sort of deteriorated in terms of structure now that we've broken the 50, if this is going to be a legitimate break of that 50 exponential moving average. So that's a quick recap of the first 3 stocks. Again, this is outside the list of our top 12 individual trade list. If you are interested in further analysis, there will be a part 2. And what we'll do is we'll move through LUV, MU, and also X moving forward, okay? So all the best, everyone. I hope you found that a little bit useful and you've learned a little bit from that. I'd encourage you to have a look at part 2. And if you do also want to take this further, I would encourage you to have a look at that pro analysis class too. All the best, everyone. It's James signing off on this part 1. I'll be back with part 2 very soon. All the best. Goodbye.